12,570 and 6,007 director salaries for 2026-27, including PAYE, national insurance and costs.
For UK company directors planning for the 2026 to 2027 tax year, a shift in payroll rules has created a specific financial trap. This chart shows the change. The employer national insurance secondary threshold has dropped from £9,100 down to £5,000. Because of that drop, paying yourself a standard £12,570 salary now triggers an immediate cash bill of £1,135 in employer national insurance. When business owners see that new expense, the reflex is often to slash their salary down to £6,708 just to dodge the tax. I'm a senior tax expert at My Tax Accountant, and we specialize in finding the most efficient extraction strategies for UK business owners. The core dilemma you face right now is deciding whether to minimize your upfront payroll costs today or accept them in exchange for larger corporation tax relief at the end of your financial year. Choosing to avoid national insurance saves cash now, but it reduces the expenses your company can use to lower its tax bill. As we will see in the numbers, that smaller deduction often results in paying more to HMRC overall. This flowchart breaks down our first persona, the profitable sole director who does not qualify for the employment allowance. If you set your salary at £12,570, that wage is a deductible expense. At the 19% small profits rate, your company saves £2,388 in corporation tax on the salary itself, plus another £215 on the national insurance, totaling £2,604 in tax relief. To get that relief, you do have to pay the £1,135 upfront national insurance cost. But when we subtract that cash bill from your corporate tax savings, the £12,570 salary leaves you roughly £401 better off over the year compared to the lower £6,708 salary. For companies with higher profits paying the 25% main rate, that net benefit gap doubles to over £800. And on a personal level, taking a £12,570 salary triggers zero employee national insurance. That zero tax status applies to Scottish taxpayers as well, because the personal allowance fully covers the income. For a profitable business, paying that immediate cash for employer national insurance is an efficient investment that results in a larger tax reduction at year-end. Our flowchart now moves to a second scenario, a company operating at a trading loss with no immediate corporation tax liability. In this case, the math breaks. The tax deduction has no immediate value because there are no profits to offset, leaving the £1,135 national insurance bill exposed. Incurring that cash cost during a loss burns through your available cash for a future tax relief that might take years to actually use. In this specific situation, dropping your salary to £6,708 is the superior choice to preserve your cash flow. But if you want to save as much cash as possible, why not just pay yourself zero? The government sets a lower earnings limit, which for 2026-27 is £6,396 per year. Setting your salary below that limit means you sacrifice a qualifying year toward your UK state pension. As this diagram shows, a £6,708 salary safely clears the lower earnings limit. You secure your pension rights for the year without triggering any tax. For loss-making companies, £6,708 is the effective compromise. It protects your immediate cash flow while securing your long-term retirement benefits. Our final scenario covers multi-director companies, like a husband and wife consultancy, or businesses with non-director employees. These companies can often qualify for the £10,500 Employment Allowance, a credit that is not available to single-director, single-employee businesses. That allowance acts as a shield, absorbing the £1,135 employer national insurance bill before any cash is actually paid. This means eligible directors can take the higher corporation tax deduction of a £12,570 salary for zero upfront national insurance cost. Choosing a lower salary here makes no sense. You would be giving up tax relief while gaining nothing in return. If your company qualifies for the employment allowance, the £12,570 salary is the clear winner. The shift to the £5,000 threshold shouldn't cause panic, but it does require you to look at the math for your specific situation. This matrix summarizes our recommendations. Profitable sole directors and those with the employment allowance should generally aim for £12,570, while loss-making companies should stay at £6,708. Regardless of the salary you choose, ensure it is processed through RTI payroll and formally minuted to stay compliant with HMRC. Keep in mind, these figures are based on the 2026-2027 rules, and your personal results will depend on your total individual circumstances. If you are unsure how these thresholds affect your take-home pay, stop guessing and get professional advice. Contact My Tax Accountant today, and we can help you build an extraction strategy that keeps more of your hard-earned money in your business and your pocket.